Hello and welcome to Idea to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates LLP. I'm based in San Francisco, California, but I work with clients all over the world who come to and do business in the Bay Area. We've got a wonderful presentation today. It's focused on how to do a venture capital financing, namely that first venture capital financing, whether it's called a Series Seed or a Series A financing. It's going to be focused primarily on those that are domestic, that is here in the United States, but I think there will be lessons of applicability for the rest of the world. So we're going to get started in a minute, but a few notes. So I'm going to be running all the tech in the background. So if you see any pauses or snafus, bear with me. It's a lot to both present and then also run the tech. The other thing to note in today's conversation is that it's being recorded. So good news is if you missed some or all of it, so long as you've registered for today's event, we'll follow up, or I will follow up within about a week or so and provide you with a copy of the presentation. Now, of course, the corollary to that is please don't share any confidential information in today's conversation, or actually even if we have a follow-up conversation, unless and until we run conflicts and get an engagement agreement in place, it's not the appropriate venue to do so. Another note is that feel free to use the chat function and communicate amongst yourselves in the room. I will not be monitoring that. I've got quite enough to monitor alone, but if you've got questions, feel free to use the Q&A function because I'll be monitoring those. And in today's format, I'll speak for about an hour. During that, if you've got questions, I'll be taking some pauses. I'll try and answer sort of questions of applicability that relate to those topics that I'm trying to cover and move through. And, we'll have about a half hour at the end for any follow-up questions. And if there are none, or there are just a few, we'll try and hit them. I'm also going to focus on questions of general applicability. So, if there's a very specific question that would only apply in an individual circumstance, may not hit it, in which case it might be appropriate to either reach out on LinkedIn or use the email, to see if we can set up a time to have just a general conversation. Again, today's information, as we're going to see from this next slide, is not legal advice. It's not intended to be legal advice. We're going to be talking about rules, and there are exceptions to these rules, and you need to know all the facts and circumstances in order to know whether or not it is a appropriate answer to your question. Corollary to that is that you're going to need to retain competent legal counsel to review all the facts and circumstances. And my off-the-cuff answers, whether in today's webinar or if we have a follow-up general information conversation, should not be taken as specific legal advice or guidance for you. It's meant to sort of provide you with information on how, we typically will see things and what are certain patterns that we'll see and see startups and other venture-backed companies go through. So in terms of a roadmap for today's conversation, we'll talk a little bit about my background. I want to gather and understand who is here in the room. So that means please fill out that audience poll. And we'll go over that. We'll go over choosing VC investors. Let me just hold on 1 second. I gotta flip something real quick here on the background. There we go. Choosing VC investors, very important. These are long-term partners if you're going to go with a venture-backed company and raise venture capital. We'll talk about preliminary considerations when you're thinking about raising money. We'll talk about term sheet negotiations. We'll go through the deal documentation. We'll talk about diligence. What's that? I don't know. You'll find out in a minute. We'll talk about side letters, and we'll hit some closing and closing and post-closing issues. We'll also probably hit perils and pitfalls. We'll focus on trying to hit your questions as well, and it'll be great. Today's conversation is probably going to cover, at least at a high level, 90%, maybe more of what you'd need to know to do a venture capital financing and raise capital for your venture-backed company. But obviously, we're only going to be speaking for an hour and a half, and so you're not going to gather everything. Now let's talk a little bit about who's going to get the most out of this. I think companies that are focused on a venture path, whether they are currently set up and planning to raise venture capital now or planning to raise in the future, If you're considering whether or not the venture path is the right path, I think that's going to be really important and good background information. As we'll discuss, not all companies should pursue venture capital financing. It is a means to an end, and it is a model. So, you got to have a business that fits in that model for it to work out for you. And, I think it looks like we have at least one person who's in academia, who's interested in learning about venture and entrepreneurship, at least with respect to venture-backed companies. This should hopefully be informative and a good discussion. All right, so who am I? I'm always trying to engage in self-discovery and figure that out. But aside from that, I am a venture capital and emerging growth company attorney. I've been practicing since 2005. My office is in San Francisco, but I work with companies throughout the US and the world. Being based in the Bay Area, that's one of the honors that we have, is that, if there are growth companies, many times, they will touch the US and if they're growth companies or venture-backed companies, there will be some involvement or some hook to the Bay Area, which is a wonderful entry point. K&L Gates is a fully integrated global law firm with but close to 2,000 attorneys and I believe over 40 offices at this point on 5 different continents. So we've got a great fully integrated network of attorneys that are familiar with venture and growth companies, both on the company side and the investor side, which is a great platform for doing these types of events. And for me, I love working with entrepreneurs on financings and as outside corporate counsel. I love bringing order to chaos, helping people grow and scale their companies. I love educating, which is one reason why I'm involved in these types of presentations. And, I also bring a bit of entrepreneurship to the table insofar as I started my practice basically at a large law firm. I then ran my own boutique for 5.5 years, I think it was at this point, before going back into big law and finding myself here. So I can bring those experiences, and I find that they really resonate with my clients, and we're able to kind of bridge the gap in a way that many times other lawyers or practitioners can't. So let's see who's in the room. I'm just going to give a moment to fill out, give folks a moment to fill out the poll, see if we can get a little bit more participation. And I'm going to just take a sip of water. I'll also note as an aside, I think it's been 10 months since I've done this particular presentation. So I feel like I've kind of like dusted it off, cleared out the cobwebs, and I'm ready to get going on it. So who is here? We're going to end the poll. Now, bear in mind also, again, so one of the wonderful things about Idea at IPO is its breadth, its global breadth. And so there are lots of folks who will not be watching this live. You'll be watching it recorded. And we are thankful and appreciative of having you join us in that means. So who is here right now? Well, we've got a strong contingent from the Bay Area, no surprise, with roughly 33%. And also nearly 50% are in the US. So we've got roughly 85% if you're counting the North America folks that are here. And then, there are some folks from South America, Europe, and Asia. I recognize this time slot is not great if you're in Europe. It's not great if you're in Asia or the Middle East. So again, if you are in one of those locales and you're watching us on a recording, you're watching me on a recording, thank you. I am delighted to have you here. As we typically get first-time entrepreneurs. So we've got roughly 45% of those folks, serial entrepreneurs who I think, when I talk to them, they always get something out of this presentation, and I appreciate that. And I start off doing these presentations live, and they were some of the best people to have in the room because they could in real time sort of echo a lot of the stories or information that I was providing. And we kind of missed that in the virtual format, but we make up for it in being able to have more breadth. And yes, those are the bulk of the folks who are here. I'm going to take another sip of water for some reason, and I apologize. My voice was feeling totally fine today until we went online and live, and now I seem to have a tickle in my throat. So hopefully I'm not coming down with anything. All right, well, if you're going to start from somewhere, you might as well start from the top. Let's zoom out and talk a little bit about venture capital. Let's talk a little bit about the model. What is the model of venture capital? Well, basically, it is set up so that for companies that can grow and scale relatively quickly, that is, they can commercialize some technology and either bring to market something new or be able to exploit a new market or develop and exploit a new market within a certain period of time, roughly 7 years, plus or minus a couple of years. And we'll talk a little bit about the structure of why that is. That's what it's for. And these companies need a lot of capital. And the basic premise is you inject that capital, you put all these inputs into a company, you put the capital from the investors, you put the ideas from the founders and the other folks who are participating, and you have folks with technical skills in sales and business and marketing and accounting. And you inject them into the company and it grows in scale and it increases in value and you get an exit. Now, not all of the money goes into the company at once. The company doesn't just hockey stick without additional injections of capital. You can see that the money is usually staged. So, if it's broken up into stages, the first kind of initial stage is the seed stage. Now, we could spend probably the entire time talking about seed stage, pre-stage, micro seed, micro VC, but let's just kind of keep it simple. Seed stage, raising a few $1 million, maybe in a couple of successive rounds, maybe in safes or convertible notes. Safes are simple agreements for future equity. Form comes out of Y Combinator, although the idea and concept has been around before that. Convertible notes that's a different presentation, safes and convertible notes, but safes and convertible notes are means by which early seed stage investors, at least here in the US, can put in a few $1 million or sometimes even more than that in a round or successive rounds to get the initial team together, to get the initial minimum viable product together, and to get it to market to start to get sales. Now, that is by and large the kind of majority of the model for the venture capital model. It is a little bit different depending upon which vertical you're in. So sometimes, for example, in the life sciences space, you're not going to get a molecule to market, right, without FDA approval, and you're going to be raising venture capital and or maybe have an exit before that. But you're sort of 95% of when we're talking about venture capital, that's kind of what the model is. And then once you've done that seed financing, you've got that as initial MVP together, you've got that initial team, you've got that product in market, you've demonstrated product market fit. How do you demonstrate that? Well, sales is how you demonstrate that. That's how you demonstrate you sort of de-risk whether or not the technology is going to be, excuse me, accepted by the market and demanded by the market. That's when your typical early stage venture capital investors will get involved and want to make those initial venture capital investments that we are focused on today. Now, so you can kind of see that on the left side of the graph here, the startup financing life cycle, and you see there's successive rounds, right? Series A, Series B, Series C, can be Series D, E, F, it can be mezzanine financings, to an exit. An exit. Well, an exit is the ability of the investors and or other owners to get liquidity. Liquidity is cash, which you can use to buy other things, right? You can use that to invest in other companies. You can use that to invest in the stock market. You could use it to create a new company. You could buy a house with it. You could buy a car with it. You could pay tuition for your children to go to college. All this happening sort of within 7 years, plus or minus a couple. And you can see on the right side, we talk about dilution. So initially the founders have all the equity in the company, but the company is not really worth much, or it's hard to determine what it's worth. And over time they get diluted, right? Because other shares of stock are sold and other equity is sold and or granted as equity compensation to employees and other service providers. But the founder's stake in everybody else is theoretically increasing as you're on that way up into exit. Now, again, we've got the little caveat on here. These figures are for illustrative purposes and should be interpreted. It should not be interpreted as being applicable to your situation, meaning, look, these are just some numbers that could work. There are companies that go public, at $3 billion valuation, others 10 billion, some are a billion. Like, you can't choose these numbers and say that they're going to be the right fit for you. You should be targeting them specifically, but it is an example or a sort of composite example of what you might expect or what you could see. Before we move on to who makes a good investor, why don't we see, are there any questions on what I've talked about to date, talked about to the minute? All right, no open questions. Again, if you've got questions, please use the Q&A function rather than the chat function, because I'm not monitoring that. So this presentation is primarily focused for entrepreneurs and others who are in companies who are raising capital. I think if you're an investor and you're watching, which we have a lot of investors, whether they're angel investors or whether they're venture investors, or whether they are corporate venture investors or other folks in the space or interested in the space, it's primarily targeted at a company focus. So with that in mind, let's kind of play to the audience, if you will. So how do you find, or how do you determine what's a good fit? Who do you want to have on your cap table? Your cap table is your capitalization table that is basically can be in many different forms, but think of it as, your spreadsheet where you've got the list of who the owners are and how much of the stake they have, shares of stock they have, or things that are convertible into stock. Well, again, you got to think about that model. And let me now that we've talked a little bit about the model, let me drill down and provide a little bit more information. If we're talking about a traditional venture capital fund, then, that is typically a limited partnership, which is a type of entity where they have limited partners, that is investors in the fund, and the general partners in the fund basically set expectations that probably they'll return roughly 3x of the fund, 3x whatever those the LPs have made into the fund over the life of the fund in basically roughly 10 years or so. And sort of traditionally, the strategy is they're going to make a lot of bets, that is investments, and there's going to be many, many losers, and there'll be some companies that are moderately successful, but they're only going to have a couple really big winners, and those big winners are going to return basically all the capital that the fund needs in order for the fund to be able to hit the 3x return that it is, set its expectations with its limited partners. So those winners, frequently kind of could be seen as basically doubling or sometimes even tripling in value every 18 to 24 months or so on their way up and out to exit. So you could see if there were a $1 million investment and let's say a series seed round, that could double to be worth 2 million at the A, 4 million at the B, 8 million at the C, 16 million at the D. Maybe there's an exit then or an IPO after that, and it's worth 32 million, right? So it could be worth 32x. Now there are a few reasons why, not why there are multiple rounds of investment. Those rounds of investment are usually tied to business milestones that the founding team puts together as part of their business plan. And so when you're thinking about going out and pitching, you need to be thinking about, how much money, how much capital does my company need to raise in order to get to scale, right, to that steady state or that point of exit. And what are those milestones or inflection points, right? Where, I can build up to here and then we'll need some more, and I can build up to here, and establishing and hitting those milestones or what's going to enable you to go out and raise more capital, because it'll build trust with your investors and trust with the prospective investors. And, those initial investors may very well and likely have additional funds that they'd like to invest, but as a way to sort of hedge risk against their losses, they will typically not put in all the money that they possibly could and wait to see if you can hit those milestones. So those are traditional venture capital funds, some of the things they're thinking about. Angel investors have different considerations. Angel investors are sort of typically individuals or groups of individuals that are high net worth, hopefully accredited investors. Hopefully all your investors are accredited investors, because that helps with compliance with securities laws. And, they have different considerations. Maybe they are they had a previous exit and they want to go out and they want to seed the next round sort of in the space, or maybe they have an interest in your area. We see this a lot in climate and energy, which is a very hot investment area right now. No pun intended. Maybe it was intended. And strategic investors, which, especially as we get towards the later stage, but we're really even seeing a lot more early stage these days. They've got other considerations that they're thinking about. They're not necessarily just motivated by the financial return. They could want to further develop the market and demand for their product or service, right? If they are a widget maker, they want to see many more companies that need to have their widgets input into their machines. They could be interested in talent acquisition or technology acquisition. So you got to pay attention to what all of their, for any investor, you need to understand sort of what their motivations are. And you need to also understand what their expectations are. And, I think it's also very helpful to understand the sort of their track record. Do they have a track record? Ideally, you're going to want investors that will add value beyond dollars. So these would be investors that can create connections to other players in the space, whether they are service providers, whether they are potential employees, whether they are access to customers or access to suppliers. You want investors that are going to be supportive of the company. Almost no company grows and scales without hitting some headwinds. So you're going to want investors that you can rely on and will be there for the long run through the thick and thin. And, when you're raising, I think it's helpful to run a really systematic process. I mean, first and foremost, you want to be out developing relationships before you need to raise money. That is so you can build a pre-existing substantial relationship. It'll make it easier if and when it's time to make an ask, because those investors will already know who you are and seeing some of your successes. Some of the best ways to raise is to run a drip campaign. And you want to make sure that you also, you want to make sure that you've kind of classified who's a great fit, basically kind of your reach, who you think you can get, and sort of your safeties. And you may want to also practice your pitch a little bit. And this is so that you can hopefully find the ideal set of investors, probably one to lead the round and several other follow-on investors. And again, you want to make sure that you've got enough capital in the bank before you start this process so you can go out and make good decisions. You can't get leveraged. Let me take a pause here and see if we've got some questions. Okay, so we've got a question about how does an entrepreneur raise capital before market traction, even though they have already spent tons of time, money, and research to discover what they think will be a huge product, but the launch needs money to run the operations properly. How does someone who doesn't have connections really save time and find an investor? So I think this goes to, again, sort of knowing your audience. And, there are lots of online resources, PitchBook, Crunchbase, where you can find out lots of things about investors, who they are, what they're interested in. They have their own websites. And I think you gotta run a good ground game to understand what the market is. Now, lots of investors will not invest. Lots of traditional investors, traditional venture investors, even early stage traditional venture investors will not invest in pre-revenue companies. Not all of them, but many of them. Now, some will have micro VC funds and other things that will play sort of in the angel space. But if you are truly, don't have any market traction, it can be really hard. And so that's kind of what you need to be relentlessly focused on, because again, they use that as a validation. And it's not just me who says this. I mean, you can go out, there are lots of articles on it. I think the Harvard Business Review maybe has an article from the 90s, which I think is still true today, sort of talking about this. And there's a lot of other things. Resources like Medium has a lot of great articles on them you might want to check out. So with that in mind, let's talk a little bit about preliminary considerations. So again, how to do a venture capital financing? Well, first you got to get to one, right? So we just kind of talked about the landscape. So, kind of takeaways from this are, what is a venture model? Does my business fit in a venture model? Can I tell an authentic, true story that fits in that model that will motivate and inspire investors to invest in my company, right? What are some of the things that they would be interested in? Well, of course, obviously they like the technology, but it's not just about the technology. It's about them being able to get a return for their investors. So you got to be able to tell that story. Like, look at this market traction. Look at this growth. Look at this takeoff. Which is different than maybe in the angel and seed stage, which is a different presentation. And if you're interested in that type of information, I do other presentations on that. I know Idea to IPO also has other resources on it. I have put together a resource that is in sort of beta test mode right now called Venture Capital Training Camp. I'm not emailing. In the chat, I put a link. If you want to sign up, check it out. Talk about formation, talk about seed financings, kind of what you need to get here. This information from today's presentation, some of it's also in there. So feel free to check it out and give me feedback, because it's a work in progress. Now, preliminary considerations, correct structure, corporate structure. We do not have time to go into all of that today. I will tell you, it could be another plug or whatever for Venture Capital Training Camp, but traditionally, probably 99% of these companies, venture-backed companies, are going to be Delaware C Corps. Again, we're talking about here in the US. What motivates that is the investors. The investors will insist on it because they've got limited partnerships, which are pass-through entities. That means the losses and profits are passed through, so they don't want to pass them through to their limited partners. So they got to have that corporate block or that C Corp in place. And if you don't have a Delaware C Corp, but you got market traction and you got good relationships with your current investors and other stakeholders, that can get fixed and patched up. That's like a topic for another day as well. But that's kind of what we're talking about here primarily. Delaware C Corp. Now, the name of the game in many respects is selling a piece of the company, a significant piece of the company. 10, 15, kind of typically 15 to 25% of the company, typically in that initial round. Although we will take a look at sort of a pro forma cap table, and you see maybe why 15% doesn't mean the founders will necessarily have 85% afterwards, because of things like current investors who might be in there, and safes or convertible note structures, and or the stock option pool. But all that brings me to the importance of round modeling, understanding who's going to own how much at the end of the round. That is critical and important for understanding, one, economics, both of this deal and what an exit would look like, and two, control. Okay, because typically, you know, when we think about venture-backed companies, founders initially have all the control, and then they give up more and more control, and maybe at time of exit they may still have sufficient or majority control over it, although many times they will not. And that is the name of the game, because you're utilizing other people's money, and that control is not necessarily meant to be an evil thing on the part of the investors. No, it's a risk mitigation tool, similar to not putting in all of the money that they have in reserve, or, you know, in the first round, right? Seeing how you do. Do you hit those milestones? You know, these rights that they're looking for are protective in nature, especially in venture, as opposed to some other forms of fundraising. Picking and choosing a style of the deal, again, sort of US focus here, but there are a few different styles or flavors. By far, the most common these days is we're working from the National Venture Capital Association's set of model documents. Now, just because, there's a link on the slide, check them out. Just because we're working from templates, though, I think, especially if you do check them out, you will see there is a lot of work to be done in order to make that template appropriate and fit with the deal that you cut. And we'll talk about cutting that deal. Now, another flavor is sort of NVCA light, which is sort of having a rough basis on the NVCA documents, but cutting out some of the provisions from them. And then still around, but probably less common, is sort of the true seriesseed.com series seed documents. I say the true seriesseed.com documents because lots of times these days, there will be a round that's called a series seed round, but it will actually be based on the NVCA forms. And so in many senses, it is a Series A deal, all but in name. It's basically a Series A deal, but you just use Series Seed instead of Series A. And historically, going back to the early teens, and before, each law firm kind of had its own flavor of venture documents, but those, I think, by and large, have been done away with. Now, again, you can't just take the NVCA documents, like print them out and they're good to go, because there's too much optionality in them. And each deal's got its own unique attributes and other things that get baked into a deal. But that's, I would say, probably about 80% of the deals that I see, especially US deals. So we're going to spend some time in a minute kind of walking through what the specific terms of the term sheet are, but let's just stick with the main point here, which is that you're selling a piece of the company. And that's kind of the main thing. So even before we kind of get into the term sheet and what the terms are in there, let's talk about the main one. And to understand how much of the company you're selling, you need to understand a few concepts. And sort of one of the cool, but also sort of frustrating things in this area is that terms that one would think have a precise definition are somewhat fluid. There's usually a little bit of a range, but that's why you got to read the fine print on that. So kind of sticking with the most common flavor, understanding the concept of pre-money valuation is the value of the company immediately before the next round of investment. And the post-money is the value of the company immediately after the round. So you could actually do the math on it, where basically you take the pre-money, you take the value of the deal, that is the amount of the investment, and then that's the post-money, right? And we'll kind of walk through that a little bit in a second on a slide. Another concept is fully diluted basis. And again, you got to read You got to work with your attorney and you got to read the fine print on all of these things. But fully diluted basis. I think the easiest way to sort of think about that is all common stock and anything that can be converted to common stock, whether it's preferred stock, warrants, options, or the option pool, sort of expressed in common stock. Now, the sort of corollary here, which again, may be a gentle plug for Venture Capital Training Camp or another one of my presentations, especially the ones on safes and convertible notes, is that you can't really know what a safe or a convertible note is going to convert into unless and until the series, whatever that preferred round is. Now you can model it out. You can build pro forma cap tables. Those are models of capitalization tables based on assumptions, but you can't really know. And then we just talked about names for price rounds. They can be called Series C, they can be called Series A, they can be called Series A Light, lots of different names, but we're talking about sort of the, preferred round. So here is kind of like, hypothetical cap table at a Series A, which is actually after a Series seed. And you can sort of see kind of pre-money, we're talking about $40 million with a $10 million investment. So that means at the end of that new round, the new investors, those Series A investors, are going to have roughly 20% of the company. You can see that in bold kind of at the bottom. To figure out what the new investor is going to pay on a per share price, you take that pre-money valuation, divide it by the number of pre-money shares, the 37 million, and you can see they're going to be paying $1.08 roughly for each of their 9.25 million shares. And you can kind of see, one reason why I wanted to use this slide rather than just do like a straight up initial preferred slide, but we actually have in the pre-money here, we actually show preferred stock, 5 million shares of preferred stock already outstanding. I wanted to have you see that, at the end of that Series seed round where 5 million shares was sold, the common, which are probably going to be those founders and maybe some early employees, they've only got 54% of the company. And that's because, and I'm just kind of telling a story here, a story that could happen that I've sort of, seen happen, maybe not specifically these numbers, but this is like a composite sort of story. Story here would be something along the lines of, they did a Series seed round. They got some market traction. They did a Series seed rounds. I don't know, something happened. COVID happened. Some other change, one of the founders left, or there were some other headwinds. They got in a tough spot. They kind of did a bridge financing based on some safes. Maybe they got a venture debt and they got some warrants that they got some warrant coverage from that. And obviously they've issued options to their employees and other folks. And so but then they weathered the storm. Maybe they made a pivot or, maybe they got access to a really large customer or a set of customers. And now new money wants to come in. And unfortunately, they didn't really have to do a full recap. So that'd be a whole nother aside, which we don't need to go into today. But, they weathered the storm, their valuation's gone up, and now some new money wants to come in. That's how this could happen. And you could see, at this point, at the end of this, the common, which are probably those founders and early employees, have 43% of the company. So term sheet negotiation. So take that in mind. That's kind of like the economics are sort of the main aspect here. Okay. But there's a lot of other important stuff that gets negotiated in term sheets. And how do you get to a term sheet? Well, hopefully you run a process, you've identified the right VCs, you've had some you've done some work with your attorneys and sort of advisors to kind of map out what you think is like an ideal term sheet. You've sort of socialized it in your discussions with these potential investors. You've modeled out what your ideal sort of economics are going to look like. And you're going to work on some of these other things, right? So when we're talking about the economics and how much of the company is being sold, we've already done most of the work for that. But that's also kind of like the most important it's probably the most important aspect of a deal here. Other terms on there are dividends. Dividends are funds that would be paid to the owners of the company, which typically, unless you're like in a down round situation or you're raising from somebody other than a venture investor, nobody's going to be seeing any dividends for quite some time. So they're not highly negotiated. I've sort of actually I've bolded sort of the terms that we sort of see negotiated a little bit more heavily than others. Liquidation preferences can be key here. So liquidation preferences is if the company is sold or goes under, who gets paid first and how much do they get paid? So many times, and it's been a very company friendly market, Bay Area, rest of the US, that we will have a situation where there will be, the venture investors will get either the greater of their money back or they will participate along with a common. They kind of won't get both. But that's not necessarily what always happens. They could get 2x, they could get the greater of 2x or participate, or they could get, 1x or 2x or 3x and participate. And you got to model that out because you got to understand, if there's an exit and and you got to make assumptions here. And this is beyond the scope of today's conversation, but again, maybe a gentle plug for the Capital Training Camp where we've got spreadsheets and all kinds of fun stuff in there. I'm experimenting with those things. We do talk about kind of what liquidation preference are, and you can see on a spreadsheet how, depending upon whatever that liquidation preference is, the company needs to sell for this amount in order for the founders to get any money or those other common holders to get any money, and kind of what that looks like. Protective provisions. So these are things that the company will not be permitted to do without sort of the sign off or consent of its venture investors. A little bit less heavily negotiated is just the ability of the preferred to convert into common stock. So that's one of the features, right? So what is preferred stock? I don't even think we kind of talked about that, but actually let's start. What is common stock? Common stock is the measure of ownership in a Delaware C Corp and many other corporations here in the United States. We convert and we will use percentages many times when talking about ownership interest, but really what we're talking about is the number of shares of stock somebody holds over, that fully diluted basis, which is basically the denominator, the number of shares of stock that are outstanding or anything that can be converted into common stock. That's how we get to the percentages. Common stock's got a couple attributes: right to elect certain directors, right to dividends. Again, typically nobody's seen any dividends for quite some time, so not really something to spend a lot of time fighting over. Preferred stock has preferences, that is, additional attributes. And that's what many of these things are that we're talking about here, these liquidation preference. Maybe special voting rights, these protective provisions. They get sort of the veto right. That is a negative control right over certain actions by the company. The ability to convert into common. Now, why would they ever want to convert into common? Well, usually usually that doesn't happen unless there's some issue with the company. There needs to be some sort of restructure, or there needs to be some sort of change in order to attract a new investor or a new round of financing. But they may want to convert into common stock so that they can have control of basically the common and or potentially who the common investors are, the common directors are. That's going to be on the board. And the board is the group of human beings that makes the decisions, by and on behalf of the company. They are vested with management of the company. And then, of course, there are the executives and officers who, president, CEO, vice presidents, treasurers, secretaries, et cetera, who carry out they usually carry out the day-to-day operations. And the board, of course, elects and determines who's going to be the officers, and it's the stockholders who determine who the board's going to be. But one of the things that you will negotiate in your typical term sheet is who's going to be on the board. So board composition is very important. That's sort of on the right-hand corner. We kind of jumped ahead to that. Who's going to, what the board composition is going to be like, whether or not the investors will get a board seat. And I will say it is not preordained that at initial financing that the investors will have a board seat. They probably will either have a board seat or observer seat. It just sort of depends on the company. It is far less common to see a legal opinion these days, especially in early stage companies. It adds a lot of expense. Preferred stock financings are already orders of magnitude more expensive than safe and convertible note financings, which is why safe and convertible notes financings have become very popular. It's one reason why they've become very popular for early stage companies, raising their seed rounds, et cetera, for the first few million or sometimes even more than that. The right of first refusal and co-sale agreement, those, I bolded them, but maybe I shouldn't have. I mean, I feel like ROFRs and co-sales are probably pretty standard these days. And that is basically, the investors will want to see that the company has a right of first refusal over the stock, certainly of the founders and maybe other sort of key employees. And then perhaps a secondary right will go to either the investors or to very large investors. That is, so if the founder wants to sell shares, the founder needs to first tell the company, and if the company doesn't want to buy them, then the investors or those large investors, those major investors, will get a right. And a co-sale right is that the investors, and perhaps just the major investors, will have a right to sell along with the founder if neither, the company buys all the stock that the founder wants to sell, or those investors with the secondary right don't buy all of those shares too. Drag along, really important. A drag along is a contractual obligation of the folks who are parties to that drag along agreement to vote in a certain way, usually in favor of an exit, if upon the happening of certain events. So typically it's, the board and the founders, or the key holders, usually typically founders who are still providing services to the company. If the board, those key holders, and then probably it's majority of the preferred also vote in favor of some sort of event, then everybody who's a party to that agreement will need to contractually vote their shares that way. That's protective of the company, especially in exits, against appraisal actions. Those are rights to sort of unseat or receive different compensation for their shares, and they're expensive. Those appraisal actions are expensive. Registration rights, these are rights to register the shares of stock of the company on an exchange. Anti-dilution protection, that is, if the company hits some headwinds and has to do either a flat or a down round, or, a flat, which is many times a flat, i.e. a round where the pre-money valuation is the same as what the post-money valuation was in the last round, which you say, well, it's not really a down round, but actually it probably is when you do the math and you sort of see what the per share price is. Yeah, again, you need to crunch through these things. And that's in part usually because of what happens with the option pool, et cetera. But anyway, anti-dilution rights are the ability for those current investors to get basically additional shares if the company faces headwinds and does a round, and they would get diluted basically. But again, they're usually only triggered if the company has hit some headwinds. Vesting for founders, it's very critical and important to see vesting in place. If you're already vested or never vested, you will need to subject your shares to vesting. How much is subject to negotiation? Sometimes you can get substantial credit for time served. Who's going to document the transaction? Is it going to be the company that's drafting or the investors that are drafting? That's a little bit culturally driven. I would say probably being here on the West Coast, it's common for the company to draft. East Coast deals 50-50. Sometimes the investors draft, sometimes the companies drafts. Attorney's fees for the lead investors to cover the lead investors counsel or cover a portion of it. Also negotiated. Would not typically see that uncapped. So work with your counsel on that. And no shop and confidentiality provisions, basically saying that you can't go out and shop the term sheet once you get it. We've already talked about whether investors will get a board seat or an observer seat, and pro rata rights. So that's the ability for investors, or many times the major investors, to acquire additional shares in future rounds. And again, this is important because it's important to them, because part of the model and part of the way that they mitigate risk is by not deploying all the capital that they could into the company until they see how you do, to see whether or not you can actually hit those milestones. And so they want to be able to not get squeezed out of the next round if they see, yeah, you're knocking it out of the park. So those are important. Let me just take a look at my notes here, see if we've got any questions, and then we'll move on to deal documentation. Great. All right, deal documentation. We've already foreshadowed this a little bit by saying, let's talk about the structure of your deal. Is it going to be an NVCA deal? Is it going to be an NVCA light style deal? Is it going to be a Series C.com style deal? Again, vast majority these days, the US-based deals are NVCA style. In those deals, you're going to see the main financing documents, which are the stock purchase agreement, which governs things like how many shares of stock are being sold, at what price, representations and warranties by both the company and the investors. So these are statements of fact by the company investors that certain things, by the company and also by the investors, that certain things are true and correct. Closing conditions. These are items that have to happen in order for the closing to occur. The closing is the actual sale of stock, the delivery of the money in exchange for the stock. And we'll talk a little bit in a moment about the interface between reps and warranties and diligence. So just kind of put a pin in that and we'll keep chugging along. The amended and restated certificate of incorporation. This is a document, sometimes also called the charter, that is filed in Delaware, because we're talking about Delaware companies. It governs, it's kind of like the Constitution for those who are watching us from the US, the Constitution of the corporation, basically who's got what rights, who gets to vote on what, where those protective provisions are, the anti-dilution provisions, those types of things. Investor rights agreement, or where, and what, I don't know if you can sort of see this or mentally see this, but kind of what I'm doing right now is I'm taking stuff from the term sheet and I'm kind of telling you where it is in these agreements. And you can, of course, check out those agreements online. But the investor rights agreement contains lots of things, which include the registration rights, information rights, that is the ability of investors to get information, certain covenants that the company will certain promises that the company is making that they'll do after closing, those types of things. And then the right of first refusal and, the voting agreement contains, the provisions governing what the board composition is going to be, who's going to have what seats and who's going to determine those, as well as that drag along that we were talking about. And then the right of first refusal and co-sale agreement, self-explanatory there, so I don't need to spend too much time on it. But those aren't the only documents. It's like, but wait, there's more. There are board and stockholder consents that have to be done. Many times, if you've already raised money, certain investors will have side letters, and we'll talk about side letters in a minute. And other things. So you're going to need to go out and get waivers. These are sort of documentation saying, yes, it's fine for you to go ahead and do X, Y, and Z. There's going to be a pro forma cap table that everyone's going to agree on, potentially legal opinion, which are not as common. And then many times there's going to be a lot of corporate cleanup that needs to get done before, during, or after the financing. So let's keep chugging because we're kind of running long here. Side letters or letter agreements outside the main financing documents. They commonly will cover things like information rights. So maybe there's an investor who's not a big enough investor to get certain information rights in the investor rights agreement. Maybe they'll pick them up as a matter of contract there, or like the observer seat, or pro rata rights, or, especially sometimes if you're doing a deal with a strategic investor, there could be some sort of commercial agreement or something along those lines that gets baked in, either, right to, have them as a supplier or to sell to them, or other things. And then there could be other risk mitigating covenants, like, you will perform this audit or do this thing before X, Y, and Z date, those types of things. Let's talk about the due diligence process. Well, the steps are basically the investor will request a whole bunch of information and you'll open up a data room, which many times we host if we're doing deals, but it's the equivalent of using Box or Dropbox. And they're going to ask for all the documentation surrounding the company, basically all corporate records. So all board consents, all meeting minutes from boards. Same thing on the stockholder side. Stock issuances, the security issuances, both all the records related to that, your business plan, your financials, your material agreements with your customers and your suppliers and, your other service providers. They're going to want to inquire and understand, is there any ongoing disputes or litigation? Is there the potential for that? Sort of one axiom we see in these types of deals, or in this field, is nobody wants to buy a lawsuit, or at the very least, they don't want to buy a lawsuit without knowing about it. So, if there is a dispute or litigation, it is not necessarily a deal killer. It needs to get disclosed, and it needs to, the investors just need to be made comfortable that it's not going to impact the business, or if it does impact the business, there could be a valuation adjustment. Again, because they're gearing to get that return for their own investors, right? They are professional investors, especially the venture capital funds. Everything related to intellectual property. So one of the key components, there are a couple just high level key ingredients in these companies, right? Memorializing and understanding who's got an ownership right in the company, what those are. Okay. Employee and other service provider agreements get kind of like hook in that aspect, and intellectual property, right? Those companies need to be, these by and large, most of these companies are, the play is develop intellectual property, develop technology, and get it to market. So you want to make sure that these things are protected. They're going to inquire in diligence about your subsidiaries, and then all kinds of miscellaneous other stuff, anything else we should know type thing that could impact the deal. And the interface between documentation and diligence is this. Diligence is basically due diligence is the process by which the investors obtain information about the company and assess the risk of the investment that's being made. Like when they actually get in there, their lawyers get in there and they actually look at the documents, and they're making an assessment. In the deal documentation, the representations are statements of fact regarding certain categories of risk and other things, which, when read in connection with the disclosure schedule, which is sort of another document that we put on that is appended to the stock purchase agreement, like when you read those two things together, they're true and correct. And so there's like a cross-checking that goes on here, right? The company is making factual statements, like all contractors have signed contractor agreements. Okay, that's sort of one. That's a simplified sort of form of one. But it turns out actually maybe there is one contractor who did not sign a contractor agreement. Now, what would be in a contractor agreement? How much they're paid, a confidentiality agreement or clause in there, and that all intellectual property is going into the company. Okay. Well, if it's not true that all contractors have signed these agreements, you would put on the disclosure schedule, except for Bob. Bob didn't sign. Okay. And then there's a cross check that goes on where the investors would want to see, well, who is Bob? They'll do diligence. They'll do their due diligence. Who is Bob? Oh, Bob worked for one day, and Bob's job was to get bagels from the bagel store. Okay. Bob was not privy to any confidential information. Bob did not develop any intellectual property. There can be an assessment that's made that, sure, so what? It's possible Bob could come out of the woodwork and say, you know what? I actually wasn't a contractor. I was a part-time employee, and they goofed on the wage and hour laws, but that's probably not a material risk for the company. And so that's kind of how those things will sort of fit together. Again, representations are statements of fact that need to be true when read, in conjunction with the disclosure schedule. In the meantime, the investors will be doing their own due diligence, looking through all the documentation, taking a look at the census of the employees, and sort of cross-checking, making sure not just the employees, but service providers, et cetera, sort of cross-checking all of this. And to the extent something gets raised, either in the disclosure schedule or they find it, there are communications back and forth where they can do a risk assessment and whether or not they want to proceed, or whether or not some sort of other adjustment needs to get done. Another thing in that situation could be, well, you know what? I don't know, we are worried about Bob, so we want you to go out and get him to sign a release before we'll close the deal. Probably unlikely if Bob really was only just getting bagels and he just worked for one day and was working for 3 hours, but you never know. And we talked about covenants, which are typically in the investor rights agreement, which are contractual obligations. So it could be in this Bob scenario, and this Bob scenario is just one that I've sort of made up, but it kind of lines up with stuff that we typically will see. We're not that worried about Bob. We'll still get the deal closed, but we at least want you to go out. We want the company to go out afterwards and do make a reasonable attempt at trying to get him to sign a release, something like that. So let's talk about closing and post-closing issues, because we've run over a little bit, but I think we're doing a good job today. So closing, get all the deal. Okay, so the mechanics of typically is that all the documentation gets agreed to. All the investors get an opportunity to see it. Signature pages get collected and sort of held by the attorneys in escrow until closing. That is, we hold on to them. No one's allowed to have them. They're allowed to see them, but we're not releasing them to get the deal closed until everybody's sort of agreed that we've gotten everything that we need. And then we kind of put them all together and inventory everything. And what we would see? We would see a board consent. We'd see the stockholder consent. We'd see the filing of that certificate of incorporation. Then we'd see the money coming in and the shares getting delivered. And post-closing, there's stuff to do. So, we did not spend a lot of time on securities laws, which are very important here in the US and elsewhere in the world. Okay, so those are laws that are, have a consumer protection orientation to them. I don't want to go into all, but many times, there will need to be some filings either with the SEC, the Securities and Exchange Commission, and or the various states from which you raised money. So those things happen after closing. Corporate notices, 228 notices go out, issuing stock certificates, and a closing binder is basically those 15, 20 documents all compiled, put in a place, so they're easy to find after the deal. Common pitfalls and traps. Negotiating before you have run a proper pro forma or sort of spec'd out what your ideal term sheet is. Now, it could be you put an ideal term sheet together in your mind, and you're sort of socializing this in the market, and you say, it's way off. Like, no one's ever going to go for this. Well, in those instances, you've done a market check, and maybe need to readjust your expectations. Securities laws issues. So let me just say, failure to comply with these. One, if you are a ne'er-do-well and you're out there raising money and defrauding people, you can end up in jail. You can lose your assets. That is real. There are headlines, of, white collar folks doing that. More commonly, people are not out there defrauding or intending to defraud anyone. But if you do not comply with these laws, the sort of more common pitfall is the investors may have a right of rescission. That is a right to get their money back. And if the company is not in a position to pay that money back, and or the company is not more valuable than it was before, you could end up tanking the company. And finders, using people who promise to find you money in exchange for something of value, whether it's equity or cash, or that can be a securities law violation. And we see that coming up. There are a lot of folks, they don't even know that they're not allowed to do that. But unless you're using a registered broker dealer here in the US, you got to really, even then you need to be careful, but it really raises a red flag. Poor record keeping. My goodness, it can cost so much money to fix corporate mistakes from earlier, or mistakes with respect to hiring employees or other service providers, or commercial deals where you've actually given up the rights to your intellectual property. So be careful there. I understand that startups, especially initially, have limited means. And so it's hard to spend a lot of money on legal, but just understand it's going to get paid for, maybe more later. And maybe that's just kind of when you're matching cash for the ability to play with it. But it can really add a lot of time to these deals. Napkin promises, this is sort of, and these days it's kind of more in an email or a text, but come on board, 20% of the company, glad to have you start, and it's not really fleshed out. And so you don't have a good sense for who's got an ownership interest. Let me also just add real quick in terms of process. If everything is running smoothly in a good market, it can easily be 9 to 12 months to kind of run a full process. In the current market, it could be longer than that. Usually can take 3 to 6 months to kind of put together and spec out and start to engage with VCs. And then once you get a term sheet, it typically is going to be a month at the earliest, 2 months, 6 weeks to 2 months to probably get a deal actually closed. And then it also depends on what's going on. So start early, plan ahead, work backwards, understand where you're trying to go, right? Think about those curves, then think about those business milestones and inflection points, and put together a good story. So a good, authentic, credible story. Let me pause there and we'll take any Q&A that we have. Can you raise money for a company if you're only raising it from one venture capital firm without the broker dealer? So I'm not sure I'm following that question. If you're out there kind of raising money for your own company, you don't usually have a broker dealer issue. It's when someone's trying to say, I'm going to raise money for you, and they're not part of the company and they're getting something of value, that this usually comes up. Now, sometimes we get questions or problems that, this issue can come up, if there's a CEO or other employees who, or service providers or contractors who are going to get specialized, you're going to get comp out of a deal, comp for raising. Okay. But, usually if it's a CEO and they're raising money for the company, that's not not necessarily an issue, whether it's from one VC or multiple VCs. Again, there can be, for example, issues with the CEO doing it. If it's like, all right, I'm going to come on and be CEO, I'm going to raise $5 million and you're going to give me a bonus of, this when I get, of this when the money comes in. Okay. Any other questions? I'll keep the line open for a little bit. See if we have any. I'll put another quick plug for VCTC, Venture Capital Training Camp. It's again in beta, love to get feedback on it. And if you've got questions, please use the Q&A function. My pleasure. Glad to share. The question is, does my firm raise money for companies? No, we are not broker dealers. We are attorneys. So we do not raise money for companies. That's not to say I've never made an intro, but I don't, but don't get compensation out of it. It's only when there's a fit. Usually that means I have to work with the founders or team for quite some time to feel comfortable and know who they are, because I'm putting my reputation on the line when I make intros. Yes, question about links and slides and everything. So we will follow up with a copy of the recording after this, and it'll be available that way. All right. So I think I'm going to sign off at this point. If you want to reach out to me, connect on LinkedIn. Email is jason.gordon@klgates.com. With that in mind, I want to thank Idea.IPO for organizing today's event. I want to thank my firm, K&L Gates, for facilitating this. I want to thank each of you for attending. And I want to also thank those folks who are not attending live, but attending via recording. And with that in mind, I'm going to sign off and let you get back to building your great company. Thanks a lot and take care. Bye-bye.